One of self-employed taxpayers' most commonly made mistakes is that they pay old tax balances before paying their current taxes. When a taxpayer pays an old balance before paying current taxes, they most often end up filing that year's tax return with a balance due, and then they are completely unable to pay it. I've seen self-employed taxpayers go through this year after year after year, and they're never able to get out of the cycle and stop the bleeding because they're incorrectly prioritizing their tax payments. Consequently, their tax problem gets bigger and bigger each year. Prioritizing and paying current taxes is always the best approach. The IRS and states expect taxpayers to stay compliant moving forward, and paying current taxes on time helps taxpayers avoid additional penalties and interest from accumulating. If you focus only on paying back taxes, you risk falling into a very expensive cycle where new tax liabilities keep piling up. This not only makes it much more difficult to resolve your overall tax situation, but you end up paying more money overall due to the ongoing penalty and interest assessments. To stay current and compliant, you generally need to pay at least 90% of your current year's tax liability or 100% of your previous year's tax liability. Estimated tax payments are paid quarterly through the year. The deadlines for these payments are April 15, June 15, September 15, and January 15. My clients sometimes complain about not being able to pay their quarterly estimated tax payment because they've already spent the money and they just don't have it anymore. One quarter will go unpaid, then 2 quarters, then 3, and so on. Before they know it, they owe thousands of dollars for their current year taxes and they have no way of paying it. Then they file that year's return with a large balance due, interest and penalties are assessed, and the cycle begins all over again the following year. One way to avoid this trap is to pay your estimated payments in smaller increments instead of paying them quarterly, and pay them monthly through the year. This is how you do that. If you're self-employed, figure out what your total personal income was in the previous month and pay no less than 25% of that amount online towards the current year taxes. Any overpayment made for that year will be applied as a refund to your oldest balance due. For example, if I'm self-employed, in early February, I would figure out how much in personal income I earned through the whole preceding month of January. I then calculate 25% of that amount and pay that amount online towards my current year Form 1040 estimated tax. Follow the exact same steps in early March for your February income and repeat that throughout the year. If you didn't earn any income the previous month, then you don't have any estimated tax payment obligation for that month. And if you're unable to pay the full 25% of your personal income for that month, pay as much as you can. Paying something is much better than paying nothing. If you've consistently made your estimated tax payments each month through the year, when you file that year's tax return the following April, you should have enough tax payments made to cover what's owed for that year. If there is a small remaining tax balance still owed, make sure to pay that amount with your 1040 electronic filing no later than April 15th. One final thing to note is that when negotiating with the IRS for a payment plan on back taxes, the IRS will only allow current year estimated tax payments as allowed expenses if the payments are actually being made. You can't just claim an estimated tax payment amount that you should be making as a monthly expense, but not actually be making those payments. If you have questions about how to stop the bleeding and how to get current on your Form 1040 estimated tax payments, you can schedule a free telephone consultation with me at taxhuddlewithmichael.com. Thank you for joining me today. See you at the next huddle.